If you've ever wondered about this, you're not alone. Why do financial crises always seem to catch everyone off guard when the warning signs were supposedly flashing red for months? The answer isn't what the textbooks tell you. It's not about subprime mortgages or overleveraged banks or even irrational exuberance. Those are the symptoms, not the disease. The real trigger is something far more mechanical, far more hidden, and frankly, far more terrifying because it operates in a space where most people, including most financial professionals, never think to look. We're talking about the plumbing of the financial system, the unglamorous, invisible infrastructure that moves trillions of dollars around every single day. And there's one specific component of this plumbing that broke in spectacular fashion, triggering a liquidity crisis that nobody saw coming until credit markets were already frozen solid. September 2019. Remember that date. Most people don't because it happened before the pandemic dominated every news cycle. But in the overnight lending markets, specifically the repo market, interest rates suddenly spiked from roughly 2% to over 10% in a matter of hours. 10% for overnight money. Between banks that supposedly trust each other, that's not a market functioning normally, that's a market having a heart attack. The Federal Reserve had to inject tens of billions of dollars within hours, eventually scaling to hundreds of billions in emergency liquidity operations. And here's the part that should keep you up at night. They never fully explained why it happened. The official story was some vague hand-waving about quarter-end tax payments and Treasury auction settlements, creating unexpected demand for cash. That's bureaucratic speak for, we don't actually want to tell you what broke. Well, let me walk you through what the repo market actually is, because understanding this mechanism is critical to seeing how the whole system nearly collapsed. Repo stands for repurchase agreement. It's essentially a short-term loan, usually overnight, where one institution sells securities, typically treasury bonds, to another institution with an agreement to buy them back the next day at a slightly higher price. The price difference is effectively the interest rate. This happens constantly. Every single day, trillions of dollars flow through these markets. It's how banks manage their cash positions, how hedge funds finance their positions, how the entire shadow banking system stays liquid. When you hear people talk about the shadow banking system, this is what they mean. The vast network of non-bank financial institutions moving money around through mechanisms like repos instead of traditional bank deposits and loans. The repo market is supposed to be the most boring, predictable market in finance. Treasury bonds are considered the safest collateral on the planet. Overnight loans are about as short-term as you can get. The interest rates should be stable, predictable, tightly clustered around the Federal Reserve's target rate. But in September 2019, something broke. This brings us to the actual mechanics of what went wrong. And this is where it gets interesting because the trigger wasn't a single dramatic event. It was the accumulation of several structural changes that nobody bothered to stress test together. First, post-2008 regulations required banks to hold more high-quality liquid assets. Makes sense on paper, right? Banks should have safe assets they can sell quickly in a crisis. But here's the problem. What's the safest, most liquid asset? Treasury bonds. So banks started hoarding treasuries instead of lending them out in repo markets. Simultaneously, the Federal Reserve was shrinking its balance sheet. After years of quantitative easing, they were letting bonds mature without replacing them, pulling reserves out of the banking system. Again, this sounds responsible, normalizing monetary policy after emergency measures. But it reduced the amount of cash available in the system. Third factor, the Treasury Department was issuing more debt. Not surprising given perpetual deficit spending, but this meant more Treasury bonds flooding the market that needed to be financed. Market participants needed to borrow cash to buy these bonds, increasing demand in the repo market. Now add a fourth element that the Fed barely acknowledged. Large banks were hoarding excess reserves instead of lending them out. Why? Because the Fed was paying interest on excess reserves, literally paying banks to keep money parked at the Federal Reserve instead of putting it to work in markets like repo. You see where this is going? Less cash available in the system, more demand for that cash, and the institutions that supposedly provide liquidity in stress scenarios were sitting on their hands collecting risk-free interest from the Fed. When quarter end came in September 2019 with its predictable but concentrated demand for cash, corporations making tax payments, banks doing window dressing for regulatory reports, there simply wasn't enough liquidity in the repo market. The handful of institutions willing to lend cash suddenly had enormous pricing power. Rates spiked to 10%. Some trades reportedly went even higher. What makes this significant is this wasn't supposed to be possible in a system where the Federal Reserve controls short-term interest rates. The Fed's target rate was 2% to 25%. But the actual market rate, the rate real institutions were paying to borrow actual money, was 4 to 5 times higher. The Fed had lost control of the very market that's fundamental to its monetary policy transmission. Think about what that means. The Central Bank of the United States, with all its tools and expertise and trillion-dollar balance sheet, couldn't keep overnight lending rates within its target range. Not in some exotic foreign currency market or speculative cryptocurrency exchange, but in the market for lending cash against U.S. Treasury bonds, supposedly the deepest, most liquid, most stable market on Earth. The immediate response was revealing. The Fed didn't just inject cash and move on. They launched a standing repo facility, essentially promising to be the lender of first resort in these markets, not just last resort. They restarted quantitative easing, though they refused to call it that, using technical terms like more organic balance sheet growth instead. They flooded the system with reserves, bringing their balance sheet back up by hundreds of billions within months, all to prevent a repeat of that September spike. Now, let's connect the dots between what happened in 2019 and what it revealed about systemic fragility. The repo crisis exposed that the financial system's liquidity is an illusion maintained by continuous central bank intervention. There's no deep pool of money that institutions can tap in stress scenarios. There's only the Fed standing ready to create dollars on demand when the plumbing backs up. This is fundamentally different from how most people and most policymakers think about the financial system. The standard narrative is that banks hold deposits, make loans, and manage their risks prudently. Central banks set interest rates and step in during emergencies. But what September 2019 showed is that there is no meaningful distinction between normal operations and emergency operations anymore. The system requires constant Fed intervention to function at all, without the Fed actively managing repo markets, providing reserves on demand, and essentially backstopping every significant market participant. The whole structure freezes within hours. Here's why that matters. It means every financial crisis going forward will follow the same pattern. Something will disrupt the normal flow of liquidity, markets will seize up almost immediately, and the Fed will have to intervene with overwhelming force to prevent collapse. There's no market mechanism that resolves these crises anymore. There's only the printing press, and each intervention requires a bigger response than the last one. In 2008, the Fed's balance sheet went from under $1 trillion to $4, $5 trillion, unprecedented, shocking. Emergency measures that were supposed to be temporary. After the 2019 repo crisis, the balance sheet started climbing again, reaching $4. $2 trillion before COVID hit. Then the pandemic provided cover for the real explosion. $9 trillion at the peak. The Fed doubled its holdings in barely a year, creating more dollars than in the previous century combined. Now, you might be thinking, but that was COVID, a genuine emergency. And sure, the pandemic was real, but look at what triggered the financial intervention. It wasn't the virus itself, it wasn't even the economic shutdowns, at least not initially. It was liquidity, again. In March 2020, as the crisis unfolded, what broke first? Not the stock market, though that certainly fell. Not the housing market, not consumer lending. What broke was the Treasury market. The Treasury market. The supposedly safest, most liquid market in the world. The market that's supposed to be the ultimate safe haven where investors flee during crises. That market stopped functioning properly. Bid-ask spreads widened to levels never seen before. Dealers refused to make markets. The Fed had to step in as buyer of last resort, not just for mortgage bonds or corporate debt, but for Treasury bonds themselves. This is the key insight. The infrastructure of modern finance is so fragile, so dependent on continuous liquidity provision, that even a brief disruption in normal market operations threatens complete systemic failure. And the only entity capable of providing that liquidity is the central bank, creating money without limit. This brings us to the real question, which is why did this fragility develop in the first place? The answer requires going back to how the financial system evolved after 2008. The regulatory response to that crisis was focused on making individual institutions safer, more capital, more liquidity, more oversight. Banks had to hold more reserves, limit their leverage, stress test their operations, all reasonable sounding reforms. But they created a second-order effect that regulators didn't anticipate. They made the system as a whole more dependent on central bank liquidity. When you require banks to hold more high-quality liquid assets, you are telling them to buy and hold Treasury bonds instead of lending those bonds out in repo markets. When you limit their leverage, you're restricting their ability to intermediate between cash lenders and cash borrowers. When you stress test based on their individual balance sheets, you're incentivizing them to hoard resources rather than provide market liquidity. The result is a financial system where individual institutions look safer on paper, but the system as a whole is more brittle, more prone to sudden liquidity crises, more dependent on the Fed to step in at the first sign of trouble. This is what academics call the paradox of resilience. Efforts to make the system safer for each individual participant can make the overall system more fragile. Like a forest that's protected from all small fires, looks great until a spark starts a conflagration that burns everything down because there's too much accumulated fuel. The financial system accumulated fuel in the form of leverage, complexity, and interdependence. The post-2008 reforms didn't reduce that fuel. They just rearranged who was holding it. Banks reduced their market-making activities and speculative positions. Sounds good. But those activities didn't disappear. They migrated to hedge funds, private equity, family offices, and other non-bank entities that aren't directly regulated or supervised the same way. So now you have a shadow banking system that's even larger and more leveraged than before, but it operates outside the traditional banking regulatory framework. When stress hits these entities, they can't borrow from the Fed's discount window like banks can. They have to get cash from repo markets. And when repo markets freeze, which they did in 2019 and 2020, the Fed has to intervene in novel ways to reach these non-bank entities. Standing repo facilities, primary dealer credit facilities, commercial paper funding facilities, alphabet soup of emergency programs, each one designed to channel Fed liquidity to institutions that aren't technically banks, but are absolutely critical to the functioning of the financial system. What makes this significant is we've created a system that's too complex to fail, but too fragile to function without constant intervention. The repo crisis of 2019 wasn't a one-time glitch. It was a warning that the plumbing of modern finance is fundamentally broken. The system can't maintain adequate liquidity through market mechanisms alone. It requires the Fed to act as constant backstop, providing unlimited dollars on demand whenever stress appears. And here's where it gets really concerning. Most people still don't understand this. The mainstream narrative treats each crisis as a unique event with its own specific causes. Subprime mortgages in 2008, pandemic in 2020, whatever the next crisis will be blamed on. But the underlying pattern is always the same. Liquidity freezes, market seize up, the Fed floods the system with money. The trigger changes, but the mechanism is identical. Why does nobody notice this pattern? Because it's hidden in the plumbing. It's technical, it's boring. It involves markets that most people don't interact with directly. Repo markets, money markets, treasury markets, these aren't things that regular people think about, but they're the foundation of the entire system. When they break, everything else breaks too. The 2019 repo crisis should have been a massive wake-up call. It should have prompted serious discussion about fundamental financial system architecture. How did we build a system so fragile that overnight lending rates can quintuple within hours? How did we create such dependence on central bank intervention for basic market functioning? Instead, the Fed just printed more money and everyone moved on. Then COVID hit, providing a convenient excuse for even more extreme measures, and the underlying fragility was forgotten. Now, let's connect the dots to what this means for the future, because the implications are profound. First, understand that the Fed is now permanently trapped in an interventionist posture. They can't step back and let markets function on their own because the markets literally can't function without Fed support. Any attempt to normalize policy, raising rates, shrinking the balance sheet, reducing liquidity provision, will trigger the same dynamics we saw in 2019. We've already seen this play out. In 2022, when the Fed tried to fight inflation by raising rates and shrinking the balance sheet, what happened? Regional banks started failing. Silicon Valley Bank, Signature Bank, First Republic, all casualties of a modest attempt at policy normalization. And how did the Fed respond? By creating another emergency lending facility, making hundreds of billions available to banks on favorable terms, essentially backstopping the entire banking system even while claiming to be tightening policy. They're tightening and loosening at the same time, desperately trying to control inflation without triggering a liquidity crisis. And increasingly, it's clear they can't do both. This is the impossible situation that the repo crisis foreshadowed. The Fed has two mandates, price stability and maximum employment. But they've created a third unofficial mandate that trumps the other two, maintaining financial system liquidity at all costs. When push comes to shove, they'll always choose liquidity over price stability. They'll always print money rather than allow a liquidity crisis to unfold. Because they know, even if they won't say it publicly, that the system can't survive even a brief liquidity freeze. The September 2019 crisis lasted hours, and it took months of intervention to fully resolve. Imagine if the Fed hadn't acted. Imagine if they'd let repo rates stay at 10%, let institutions that couldn't access cash fail, let the markets discover the true price of liquidity without central bank support. The entire financial system would have collapsed within days, not weeks or months. Days. That's how fragile the infrastructure is. Second implication, every future crisis will require a larger intervention than the last. This follows inevitably from the first point. If the system is always operating at the edge of liquidity crisis, and if each intervention creates more leverage and more complexity, then each subsequent crisis requires more dramatic Fed action to resolve. $4. $5 trillion in 2008. $9 trillion in 2020. What will the next crisis require? $15 trillion? $20 trillion? At what point does the Fed's balance sheet become so large that it fundamentally warps all market pricing? Or, and this is the real question, have we already crossed that point? When the Fed owns a quarter of the Treasury market and a quarter of the mortgage market, when it's actively managing repo markets and providing backstop facilities for every significant financial institution, at what point do markets cease to exist in any meaningful sense? Prices are supposed to reflect supply and demand, risk and reward, the collective judgment of millions of participants. But when the biggest participant is the central bank, with infinite capacity to create money and an explicit mandate to prevent markets from falling, what exactly are prices reflecting? Here's why that matters. The entire premise of market capitalism is that prices convey information. They tell producers what to make, investors where to allocate capital, consumers what to buy. When prices are distorted by unlimited central bank intervention, that information becomes noise. You can't have rational capital allocation when the cost of capital is artificially suppressed. You can't have creative destruction when failing institutions are backstopped. You can't have market discipline when everyone knows the Fed will step in at the first sign of trouble. The repo crisis revealed this in stark terms. The market was trying to signal that there wasn't enough liquidity relative to demand. That signal, 10% overnight rates, should have prompted institutions to adjust their behavior, reduce leverage, hold more cash. Instead, the Fed flooded the system with reserves and rates collapsed back down. No adjustment, no deleveraging, no market discipline, just central bank intervention overriding market signals. Third implication, and this is perhaps the most concerning, the fragility is irreversible without massive disruption. You can't unwind this system gradually. The Fed tried in 2019, very modestly reducing its balance sheet and letting the repo market function more independently. That experiment lasted until the market broke, and then they had to reverse course immediately. Any attempt to normalize, to let market rates actually reflect supply and demand, to remove Fed backstops, to allow liquidity crises to resolve through market mechanisms, will trigger the kind of systemic collapse that the Fed is institutionally designed to prevent. So we're locked in. Permanent intervention, ever-growing central bank balance sheets, infinite liquidity provision whenever markets stress. Not because anyone chose this system deliberately, but because the cumulative effect of decades of policy decisions has made it the only option. The alternative is collapse. Immediate, devastating, systemic collapse. That's not hyperbole. That's the plain reality revealed by the 2019 repo crisis and every crisis since. The financial system is held together by central bank intervention and nothing else. What we've learned here is the liquidity crisis that nobody noticed in September 2019 was not a weird anomaly or a technical glitch. It was the moment when the architecture of modern finance revealed its true nature, completely dependent on unlimited central bank support, unable to function even briefly on market principles alone, and increasingly fragile despite all appearances of stability. The mainstream narrative focuses on individual crisis triggers, housing bubble, pandemic, bank failures. But the real story is the underlying mechanism, a financial system so structurally fragile that any disruption to liquidity flows threatens immediate systemic collapse. The repo crisis was the canary in the coal mine. It showed that the deepest, most liquid markets in the world, Treasury bonds, overnight lending between major banks, can freeze up within hours without constant Fed management. Everything since then has confirmed this diagnosis. COVID response, regional bank failures, ongoing market volatility despite massive Fed balance sheets. All symptoms of the same disease, a system that requires ever-increasing intervention to avoid collapse. And here's the final, uncomfortable truth. There's no fixing this without destroying it first. The fragility is baked into the structure. The dependence on Fed liquidity is permanent unless we're willing to accept a systemic unwinding that would make 2008 look like a minor correction. So the Fed will keep intervening. Balance sheets will keep growing. Liquidity crises will keep emerging from unexpected corners. And each time, the solution will be the same. Print more money, backstop more institutions, override more market signals, until eventually, and nobody knows when, the entire structure fails, not from lack of liquidity, but from excess, from the cumulative weight of distorted prices, misallocated capital, and the inevitable consequences of pretending that unlimited central bank intervention can substitute for market discipline indefinitely. The repo crisis showed us the blueprint. The question is whether anyone was paying attention, based on how